If we are looking for growth, we're looking for some great revenue growth, some profit growth, and of course, juicy dividend growth, we can, of course, look at Teleperformance. Now, I had a question from one of the viewers on an older video about Teleperformance and saying, hey, look, has the situation changed? What does the picture look like for this company now? And is it still an interesting investment case? So we're going to get into Teleperformance today. Stick around to the end of the video because I will go over two of the key things that you will need to watch if you have an interest in investing in Teleperformance. So I am here on the website. Now, this is their About Us page. I'm going to skip over things like awards, but it's just who they are. So they're a global digital business services company. Now, in essence, what this means is it means that other companies will outsource. They will pay Teleperformance to take part of their jobs off their hands. Now, what that means is the customers for Teleperformance don't want or are going to be distracted by undertaking particular business activities. It's not their core competency. It doesn't really contribute to how they are creating value to the customers, and so they will pay Teleperformance to do that job for them. Now, Teleperformance works with nearly 500,000 people around the world speaking over 300 languages. Now, that means they have scale, but it also means that ability to have people speaking different languages, that means that they can also get down and get local and respond to customer needs in a particular location. Now, you'll note that they not only are globally diverse, but they also want us to talk about how highly skilled that workforce is. And I think that's important. We're going to come back to this issue later on. Now, it's not just outsourcing. It's not just business process outsourcing. Here as well, there is also this element here on customized solutions. So they provide comprehensive AI-powered service portfolios from front office customer care to back office functions, including trust and safety services, focusing on defending both online users and brand reputation. Now, brand reputation is, of course, going to be paramount for many of their big corporate clients as well. The corporate clients are going to want to maintain brand reputation. So they also have a range of other specialized services there. Fantastic. So this is nice. So what does all this mean? How does it all piece together? And how can we tell what's going on with Teleperformance and perhaps what's driving their performance? Okay, welcome back. We are on the Koyfin website. Now, Koyfin is an absolutely fantastic platform here that gives you range to a diverse range of companies across the world and some fabulous investment opportunities. It brings analyst and institutional level data into your hands. There is a link down below. If you're interested in trying out and you want a nice juicy discount, please do click on the link. I will receive a small commission and that will support this channel and it will support me to make more amazing videos. So just to show you a little bit about Teleperformance, what we can do is we can go in here and Teleperformance. Now, it's important to note that Koyfin does have an absolutely global platform. And so what we see here is we see a range of different listings. We don't necessarily want I don't want today to look at the US listing. So this is an ADR, an American Depository Receipt. It's like a secondary market trading, allowing people in the USA to trade on their exchange. It allows people in the USA to trade on the exchange and actually get access to the underlying stock. Personally, I have access or can access the actual native listing where the headquarters is. So I'm going to be looking at the French, and this also has really good analyst coverage as well. So if you're wondering, hey, look, why is there very poor coverage of TLPFY in the USA? Let's have a look at TEP, the actual Teleperformance in France. So I'm going to go here and I'm going to just pull up their overview here, and we can see that it was on a tear. COVID and like many other stocks collapsed quickly and then rebounded and went on very strongly here though, up until this point here at the very start of 2022. And then it started a decline and we've seen this just declining since. So it's gone from a high here of about $400 all the way down here to $120. So we've seen a substantial decrease in the value of this company. Now, one of the big questions is whether or not this is warranted and what's going on here. Is this a good company? Does it have some existential crises ahead of it? Or is this actually a situation where investors and institutional holders have been spooked for some reason? And could there be blood on the streets? And is this a fantastic time to actually pick up shares in the company? So Koyfin also enables us to have a quick overview here of the company. I'm seeing the words sort of process outsourcing come through quite a few times there, as we saw on the About Us website. There's a whole load of separate related securities here on different stock exchanges, and we can see here that it's in the industrials sector and the professional services industry. So nothing particularly juicy there. Now, at this point here, in dividend information, I'd like to have a quick look here. Dividend yield of 3.2% with a payout ratio of 35% and a dividend per share 5-year compound annual growth rate of about 15%. So that's a very nice growth rate here for the dividends. You can see here in 2016, it was a 30% increase in dividends, and it's been declining a little bit here. It's bounced from about 14.8 to about 20 and down to about 15 again. So it seems to be what I would say is it's a very nice dividend growth stock at this point. Now, we saw the prices go up, we saw the prices go down, and one of the questions is, what does this mean? Now, what I want to do, one of the things I love about the Koyfin, one of the things that I love about the Koyfin platform is it has this percentile rank option here. Now, I can very quickly scroll down here and I can see how they look against their history here on this first major column. So it's looking at the last 10 years of their history. Green is very favorable. So in terms of, for example, valuation multiples, it's looking about as good as I would ever expect it to be. Valuation yields, so for example, the dividend yield, this is looking about as strong as it could possibly look. Margins and profitability. So the key ones here that I want to look at: return on assets, return on equity. So these are both looking quite strong. The gross profit margin is, however, a bit of an outlier here, and that's something that we could possibly look at there, but it's still looking quite nice at about 32%. Now, what it doesn't do is give me this indication about where this sits in their history. Is it 30% to 34%, for example, or is it 10% through to 50%? So that's one small change I wouldn't mind making on here. Leverage. So we can see here a little bit more leverage than it has been in the past. To some degree, I think that's quite understandable. Over the last 10 years, debt has been cheap, and I am not surprised that they've piled on a little bit of additional debt here. Now, I've switched here. I can compare from the country here, so in French industrials or France in general, through to the wider region here for European. And I think I might stop here. I had it on global before, but I think European industrials is a reasonable way of looking at this company more broadly. So European industrials, so we can see here, it's better value than most of the European industrials. It's about mid-range for many of these percentile ranks. So I think if you think about what this is indicating, it's indicating to me in the last 10 years, it has been overvalued more or less compared to some of the other stocks in European industrials. And again, here we can see again, it was mid-range for 10 years, and now it looks very favorable indeed. And again, here, looking through this, nothing too unusual here. It's sort of sitting in the mid-range of the pack here compared to European industrials. So it's not an outlier here. It looks like they're managing about as effectively as I would expect. What is Teleperformance worth today? Now, as I said, look, the Koyfin platform, I wouldn't be without it. It gives me access to a heap of data. So here, for example, we have the analyst estimates for the price target. Now, this black line here is the average. The thick blue line there is the actual stock price performance. This dotted red line is the low, dotted green line is the high. And we can see here, in fact, stock prices are somewhat near to the low analyst estimates. Now, working with several different valuation models, though, and looking at these analyst estimates here, they predominantly on the buy, some on the hold. So obviously some analysts are seeing some of that long-term weakness. But based even just simply on the dividends and the fact that I think they can continue to grow those dividends with time and develop cost savings using artificial intelligence, based on dividend models, based on some other valuation models, I'm putting an estimate here, and we see this reflected in euros, but I'm looking at this currently at about a 205 US dollar price target, and I'm looking at this as being about 60% undervalued. Now, what does that mean? It doesn't mean that it's going to go up, or I don't anticipate it going up 60% in the next short while. But what I am expecting it to do is to go somewhere closer to this value as being a level of fair value. But I believe it could easily take 12, 24, or even 36 or more months for that to happen. However, buying at this price point also means that I'm able to say, hey, look, I can collect a small dividend in the meantime. And even from a dividend yield theory, we can see that it's substantially higher at the moment than historic averages for the dividend yield. And even from this perspective as well, I think we can clearly see here that the company is currently undervalued by a sizable amount. So I make that amount about 60%, showing some substantial upside and also the opportunity to lock in some juicy dividend growth with time. Now, switching gears away from thinking about the valuation, I want to have a look at the money. Show me the cash flow as an investor. So if I click on the dividend tab here, I can get a sense of their overall yield. So the current yield is about 3.2%, and it's been as low as about 0.6%. That correlates, of course, to the horribly high prices recently, and of course, in what is, in my opinion, quite rampant overvaluation. And we can see here as well the dividend payments from $1.90, $2.40, down to up to $3.30, up to $3.85 per annum. And that's what I like to see, nice strong dividend increases. And we can see here that fairly consistently about 15 to 16, 17% annualized growth in the dividends. So it appears to have quite a nice dividend growth rate here, and with payout ratio of about 35%, it looks as though they will not be running out of cash any time soon. Now, I do want to just quickly explore a couple of elements here on the financial analysis tab. We've already looked at multiples. I'm quite happy with that. I do want to explore the profitability tab. Now, the profitability tab here for me focuses on return on assets, returns, margins, for example, asset turnover, and short-term liquidity. Now, one of the things I like about the Koyfin platform is it's got this little opportunity here for me to pull up these charts, which gives me a big picture view. And the big picture view is, of course, encapsulated in the sort of the little thumbnail there. So some of these I consider C flat, some of these are going in the right direction. So EBITDA margin, for example, appears to have been growing strongly. Now, it's important to know that these charts are not starting at 0%, so it's not multiplying massively, but it's going from about 12% here to about 16%, which is pretty good growth overall. Current ratio, now that's been decreasing. Again, it's not decreasing from 1.6 to 0, but 1.6 to about 1.2. So the chart axis here is always a little bit finicky. And so I think you do have to interpret that with a little bit of wisdom there, and just being aware that it's visually misrepresenting a little bit to us here. But what I'm seeing from all of these charts here is I'm seeing margins are going basically how I want them to go. S, G, and A margins, again, going where I want them to go broadly. So everything here in terms of profitability seems to be shaking out, and I'm liking this quite a lot. So I see a lot of the elements here that I want to see. And we can see here cash from operations, for example, is going up. We can see that there's been quite a big jump in the stock-based compensation. Now, this is one instance here where the chart actually does start at 0. And so this is, in fact, actually quite a substantial increase in the stock-based compensation. So that's something I think we do need to talk about and do need to take into account. But it's still a relatively small component of the overall company picture here. Total debt issued going substantially anywhere. Total debt repaid, so they're repaying debt, which is good. Issuance of common stock, so we've got quite a big chunk of additional common stock there issued. Free cash flow. Now, free cash flow per share is the more important metric, and this is growing strongly, and that's something I do to see as well for this type of company. It's fairly mature. I want to see them able to generate that or transform the revenue into free cash flow per share. So that's a really positive change there for me as well, and a really positive trend that I want to see. Now, one of the big questions that was asked in the question on the YouTube video, the previous YouTube video I did, was, what's going on here? Is it still a good buy? What's happening with it? And so what I've done is I've pulled up in Koyfin as well. It's given me access to, for example, new. Now, I think there's two sort of major worries or fears here. Number one is the acquisition of Majorel Group. Now, from what I'm reading, I think from memory, this was purchased at about 1.4 times sale as a multiple. So I think they've negotiated a good deal there, and I think that's looking good for the company. They paid for it a mixture of cash, so they're using some of that cash stockpiled as well as the issuance of stock as well. So I think they've got a prudent setup there for the purchase, and that's been going through since April this year. I think it's a reasonable price. I think it's an acquisition which is going to support the company. It's very much aligned with the strategic direction that the company's taking here at Teleperformance. So I do think that's good. Have they bitten off more than they can chew? It's a reasonable size acquisition at 3 billion euros. So it's a reasonable size acquisition. Now, there are, of course, dangers here. So one of the things when I'm teaching in the business school is talking about acquisitions. It takes a particular type of company to be able to fully extract the value from this acquisition. There are systems behind the scenes that they need to integrate. There's often differences in culture as well that they also need to merge and integrate. It is not as simple as it looks on paper to really unlock that value in those, quote, synergies that the managers are looking for here. Now, particularly here as well, this is not a small acquisition for the company. They don't have a history, as far as I know, of large acquisitions like this. So I think there could be some challenges there in the integration post-acquisition. So that's something I think will weigh on some of those estimates. But at the other hand, they should be able to pick up some of those synergies. They should be able to push those margins in the right directions. But it could take a couple of years, I would imagine, for some of those synergies to be fully realized. And in the meantime, we may see a deterioration in some of those metrics for Teleperformance. I can also roll through here and get their press releases as well. Now, there's a whole load of congratulatory elements here as well. Among the top 20 best workplaces in the Middle East, for example, honoured by Singapore Airlines CEO with the Service Excellence Award as an outstanding partner. So clearly, they are doing things well from both an internal perspective here in terms of being a great workplace to work, as well as recognition from their customers as well, such as here with the Singapore Airlines and the CEOs handing them this award. So I think there's a lot of elements here very quickly that I think are very powerful and very strong and will add to the investment in this company over the long term. Now, I guess one of the big challenges here is the use of AI. Now, when we think about AI in this particular context, it becomes incredibly difficult given the vast changes in what AI enables us to do. Now, just over the last 12 months, for example, I've seen the ability for something like ChatGPT, as an example, to go from being able to answer simple questions through to some quite remarkable analysis and processing of textual information. So the big question, I think, from investors and from analysts is, what does AI mean? Now that, my friends, is possibly subject for another video entirely. Now, my estimation here, the trend towards outsourcing is not going away. Just because you can internalize, in my mind, a service which is creating or taking some of the headaches out of your operation, and a company like Teleperformance is providing you with that service, it removes a whole host of challenges for you as a company. Now, even if you could, for example, replace customer service representatives with AI chatbots and do that internally, yes, you could cut out Teleperformance. Is that a good thing? I would say probably not, no, because the chatbots themselves, the incorporation and the use of this technology, this is adding to the complexity of your business, which is exactly what you wanted to get away from when you engaged in business process outsourcing to Teleperformance. So what does that mean? I suspect that the companies that are outsourcing to Teleperformance will largely continue to do. Now, with the acquisition of Majorel here, I think Teleperformance is able to expand the scope of the services that they will offer. And in fact, I think if we go back to some of the financial analysis, we look at these profitability metrics, I suspect we're going to see the impact of AI appear here on the margins. Now, over time, what I suspect will happen is with a particular single client, for example, Teleperformance will be forced to accept contracts of a lower value, generating less revenue. But on the other hand, in their internal cost structure, the use of AI will be able to substantially improve their costs and how much it costs them to deliver that service. Now, it's also interesting as well, if I flick over to the Teleperformance websites, As we see here, Teleperformance in the news. Okay, sure, earnings beat estimates. And when we look at this, there's not a lot of news here, but we've got this item here. Bloomberg Technology speaks with Daniel Julien about chatbots and AI. Now that's interesting. And if we look at the overall web page here, the About Us web page, what do? We provide a comprehensive AI-powered service portfolio. They are not shying away from AI. This is not a company where they just have telemarketers or customer service representatives on the phone. It's not a case where AI is going to cut out those humans in this scenario. That's not what Teleperformance does. As a company, as a system, this is the key component here, AI-powered service portfolio. There are people, yes, these people should become more efficient and they should be able to deliver a better level of customer service and outcomes for Teleperformance's own corporate customers. And instead, the company itself here has doubled down. They've increased their investments in AI delivery, into the ability to create more value for their customers and lowering their costs at the same time. My interpretation is we're going to see improved margins, but I suspect we'll see slower revenue growth because of that as well. Now, if you think about what that means, it's part of my mind, it's part of that wider trend towards a more deflationary environment caused by technology. They won't be able to grow that revenue base, I don't think, as fast as they wanted to, but I suspect profitability is strong and perhaps even increase, and I suspect their overall margins will grow strong and increase. And the margins at the moment I do because I see them as indicative of Teleperformance having a very strong economic moat. What I will be looking for is I'll be looking for changes in sales revenue. I'll be looking for changes in some SG&A margins, and I'll be very much looking forward to how those other margins track with time. I'll also be monitoring the analysts' calls as well and the earnings calls to get a better sense of how big these investments are and how they see these investments changing their own internal cost structures, as not just to their existing customers, but also expand the services to leverage their capabilities here with this AI-powered service portfolio and also grow their business that way. And that's what I'll be looking for. I'll be looking for margin growth. I'll be looking for sales growth at a slower rate. And I'll be looking very closely at the commentary and how they address those analyst questions around the incorporation of AI. So, my friends, what do you think? Is this on your portfolio? Is this on your watch list? Is this a company that you are interested in? Yes, they should be able to continue to grow that dividend over time. And at the moment, at 3%, it's got a reasonable starting yield. And they're growing that very strongly with time as well.